That's right, Kieran. Governor Philip Lowe has spoken a number of times over the last month about how 0.25% interest rates is the lower bound for him. That is the level that he is comfortable with. However, in the last few days, there's been some speculation that the RBA may need to introduce negative interest rates in about 18 months' time if the economy does not pick up as expected. And joining me now is Shane Oliver from AMP Capital over Skype. Shane, could you actually mean and how they'd work?
Negative interest rates is basically where the Reserve Bank takes the cash rate down below zero. So at the moment it's set at 0.25%. The Reserve Bank would set a rate of, say, minus 0.25%. So that would mean that if a bank had money on deposit at the Reserve Bank, they would have to pay the Reserve Bank to keep that money, pay them 0.25%. The theory is that it leads to a discouragement to having banks have their money at the Reserve Bank, and of course encourages them to lend through the community. The problem is that it hasn't really worked too well in Europe or Japan where it has been applied, and that's why the Reserve Bank is reluctant to go down that path.
Shane, we've just seen the Reserve Bank has kept interest rates on hold at 0.25%. The bank also says in its statement that total purchases of government bonds are still remaining at $50 billion. What's your reaction to today's announcement from the Reserve Bank?
No real surprises from the Reserve Bank. All the action on the Reserve Bank's front was back in March, believe it or not, 3 months ago now. A rate cut in early March and another one in the middle of March. And that's of course, when they announced the start of quantitative easing, when the Reserve Bank started buying government bonds to keep 3-year bond yields at 0.25%. And also they provided cheap funding to the banks. Now, of course, those policies, I think, have been highly successful. It has kept the banks afloat. It has enabled them to pass on interest rate cuts to their customers. It's enabled them to provide the bank payment holiday. So all of those measures that were put in place are working. The Reserve Bank at the moment, I think, is just in wait-and-see mode, monitoring as to whether that continues to be the case and how the economy pans out. But so far, so good. If anything, the economy is panning out in a way which I think is somewhat stronger than the Reserve Bank feared 2.5, 3 months ago.
And Shane, last week the Reserve Bank Governor suggested that JobKeeper should be extended beyond September for some industries, and he did call out retail as one example. Do you believe JobKeeper needs to be extended as well to help boost the economy going forward?
I think at the moment there is a case for the government to sort of wait and see. But if we get to September and things haven't recovered enough, or a lot of sectors are still lagging, then I think there is a very strong case for JobKeeper to be extended. And I think that would make sense. Areas would be retail, tourism, possibly home building, although that might go down a different path in the days ahead. But I think the reality is that the economy's turned out better than the Treasury assumed back in March when they costed JobSeeker. They've got $60 billion left over. That I think provides some scope, provides some flexibility, so we don't have that fiscal flip edge when we get to the end of September.
And Shane, tomorrow the March quarter GDP numbers are going to be released. What is your prediction for the March quarter?
I was sort of hoping we might get over the line and get a positive number, but there's some data out today for what we call partial economic indicators, and they were somewhat mixed, and they left our GDP forecast at minus 0.3%. So on the one hand, we will get a contribution to growth from trade or net exports and also public demand, but other sectors of the economy will be detracting from growth. That includes housing, construction, business investment, consumer spending probably, and inventories. So as a result, we do expect the economy to have contracted in the March quarter. What I would say, though, whether it's minus 0.3 or plus 0.1 may matter in terms of whether it's a technical recession or not, but it's a far better outcome than we're seeing in many other countries around the world. The Eurozone contracted by 3.8% in the March quarter. The US, Japan contracting around 1% or so. So we do seem to be doing better as we go into this. And I also think there's more signs that we're recovering faster than the US and Europe are. So Australia, I think, has managed this pretty well by getting the virus under control earlier. And also the stimulus measures have been far more robust and stronger than we've seen in other countries.
Shane, thank you for joining me. Kieran, no surprises here from the Reserve Bank today. They've kept the cash rate on hold at 0.25%, and it's looking like it's going to stay that way for the next few years.